Hello, everybody. Welcome to tonight's webinar. We've got a few people joining still, so we'll give it just a minute or two for people to log in and get set up, and we get to learn Zoom all over again. Why don't we start by just making sure the chat is working effectively for everybody. If you have access to the chat and you're not driving, hit the chat button and let us know what city and state you are joining us from tonight. And if you like emojis as much as I do, feel free to throw an emoji in there. I'm not seeing any responses yet in the chat. If any of you are available, feel free to just put the city and state that you're coming in from. There we go. South Jordan, Bluffdale, a couple of Utahns, right on. Boris, where are you from? Boris might not be able to chat, but I want to make sure that we make this as collaborative as humanly possible tonight. And there we go. Hey, Boris from Tampa, Florida. Nice to have you with us this evening. Right on. And we're live on Facebook, so we'll get rolling. Thanks, first of all, to the White Coat Investor. His forum, website, and Facebook page have been a huge help for us. They helped us promote this event tonight, which was fantastic. And in addition to that, the collaboration that goes on in the White Coat Investor Facebook page is really incredible. It gives us a lot of insights around what are the fears, the trepidations, the misconceptions about what's going on in the housing market, what's going on with mortgage rates. And that really helps us when we're preparing information like we're presenting tonight, because we take a lot of our cues from what's going on in that group. So similarly, this evening, if y'all have questions, if anything that I talk about doesn't make sense, I'd like to encourage as much collaboration as humanly possible and encourage you to ask questions in the chat. And Boris, so you're in Florida. We've got some Utah folks here. Both of our markets have seen incredible appreciation. In fact, I think Utah and Tampa, Florida, Salt Lake City, Utah, and Tampa, Florida, both are in the top 5 fastest appreciating markets over the last 5 years. So I'm sure there's a lot of concern around what is going to happen from here in terms of housing values in 2024. So I'll kick off, and let's just start with a bit of a panel. And hopefully, I don't know if everybody's driving or if you have access to your screen, but I'm going to share my screen, and then I wanted to just have a real quick survey around housing prices. So curious, do you think housing prices will go up or down in 2024? And as you're taking a second to click the numbers on the poll here, let me just start off by saying, the most recent Fannie Mae Consumer Homebuyer Sentiment Report came out, and 83% of potential homebuyers believed that that housing values, what they said was this was a terrible time to buy a home. And the reason they believed that was that they believed housing values were going to go down and mortgage rates were going to go up. So curious how that ranks with this poll. A couple of responses so far, and those responses believe that housing values are going to go up. So that's great. And let's do one more poll if we can. Let's take the poll about interest rates. Where do you think interest rates will go in 2024? Love to hear from you on where you think interest rates are going to go in the year ahead. Where did my chat go? There we go. Right on. And we got a couple of responses. Most people think that interest rates are going to go down. So that's great. Right on. I happen to largely agree, although we are seeing a little bit of trepidation, if you will, in the bond market recently. And we're going to talk a little bit about why rates have been going up and what, if anything, will cause them to reverse course and go down. So this housing market's really confusing. You know, I've been in the mortgage industry now for 22 years, and I got my first job on an apartment building at the age of 12. So I've been living, working, playing in and around real estate since I was 12 years old. And this is the most confusing market I've seen. And it's even really confusing for the experts. So, you know, here's a few of the experts out there. Morgan Stanley says we forecast housing prices in 2023 to finish the year flat, and then before falling 2% in 2024. So 2023 is flat compared to 2022, and they think housing prices are going to go down 2% in 2024. Zillow, they said typical home values are predicted to rise 6.5% from July 2023 to July 2024. So very much contradicting what Morgan Stanley says. Goldman Sachs says we're revisiting our home price forecast higher to 1.8% for full year 2023 and 3.5% in 2024. So Goldman Sachs says home prices up. Realtor.com, who you would imagine their economists would be bullish, but they say they revised their home forecast for a decline of 0.6%. And then last but not least, CoreLogic says home price gains increasing to 4.3%. So even the experts are conflicted. Home prices are going up, they're going down, they're revisiting and revising their forecasts. And that's because I believe the reason for that is because there are a lot of legitimate reasons to believe why home values could go down in 2024. And there's also a good and long set of reasoning behind home prices going up. So what we wanted to do in this webinar is try to take a balanced approach and look at the different factors and probabilities for housing prices to go down, and then contrast that with the probabilities of housing prices going up. So a bearish and a bullish case for housing. All right, so let's kick off. Reason number one to be bearish on housing: mortgage rates could remain elevated or go even higher. You know, over the last 4 months, since the beginning of June, the U.S. Treasury has sold $2 trillion in Treasury bonds and Treasury bills. And the US deficit has increased from 31.5 to 33.5 trillion. So there has been an incredible, dare I say, unprecedented amount of bond sales from the US government. And those bond sales directly compete with the sales of mortgage-backed securities. And when the Federal Reserve is, or the Treasury, I should say, not the Federal Reserve, when the Treasury is trying to get the bond market to digest $2 trillion worth of bond supply, the only way to bring the bond buyers, these are the people who run pension funds, think of the firefighter associations, the unions, the people that are funding pensions and retirement accounts, they have to have fixed income. But there's only so much money they have to invest in bonds at a time. And so when the Treasury dumps $2 trillion worth of bonds onto the bond market, the only way that they can attract enough buyers for those bonds is to offer higher and higher rates. So the reason why we're seeing mortgage rates go up is because we're seeing the yield on the 10-year Treasury go up on all Treasuries really, but especially the longer dated Treasury bonds. And as the US competes in the bond market, it's causing those yields on the Treasuries and mortgage rates to go up. Now, the good news is hopefully the Treasury has kind of refilled its coffers after the debt ceiling issue was handled in early June. And we shouldn't have as much pressure going forward. In fact, you know, the event that would reverse the trend in interest rates from higher to lower is likely a recession. And I have a slide on this later in the deck that I'll show you that in every recession going back to 1980, when we enter an economic recession, mortgage rates fall precipitously. And that's because when we go into a recession, stocks usually suffer first. The money pulls out of the stock market. They try to find safe haven investments, and oftentimes that money goes into the bond market and or into real estate and other alternative investments, gold, those types of things. And right now, we are flashing 4 really strong signs of a recession. We call this the 4 horsemen of a recession. And so let me go through these stats with you, because all 4 of these things are present right now. But in and of each of these situations, each individual indicator is highly probable of a recession. So if there's an inflation spike, 75 to 77% of the time that the US inflation rises by 3 percentage points over a 12-month period, there has been a recession within 36 months. Check, we've got that inflation spike. Number 2, if there's an inverted yield curve, that is a predictor of recessions. In fact, that indicator has preceded each of the last 8 recessions going over the last 5 decades. And usually the inverted yield curve precedes the recession somewhere between 6 and 24 months. Again, welcome to the webinar tonight. If you are joining us just a few minutes late, feel free to use the chat if you have any questions. We're more than happy to answer your direct questions if there's anything you want us to go deeper on. And for anybody who doesn't know what an inverted yield curve is, let me just explain that really quickly. Typically, the longer period of time that you borrow money, the higher the rate of interest it costs. Because from the lender's perspective, they have to make you a loan and they can't get that money back to deploy elsewhere for a longer period of time. We know this when it comes to mortgages because a 15-year mortgage has a lower interest rate than a 30-year mortgage. Well, what an inverted yield curve is when the opposite of that happens. When a 2-year loan is at a higher rate than a 10-year loan. And that's what's happening in the US Treasury markets. The US Treasury markets, up until very recently, the 2-year was paying about 5%, and the 10-year was paying a yield of about 4%. So that's called an inverted yield curve, and that's a predictor of recessions. Number 3, rapid rise in interest rates. So when short-term rates rise by either 1.5% over 12 months or 2.5% over 24 months, there's been a recession within 36 months, 69 to 74% of the time. And then number 4, when oil prices have risen by 25% over a 12-month period, the US has entered a recession 45.9% of the time. So in and of itself, each of these events are highly predictive for a recession. But when you have all 4 of these, the 4 horsemen of a recession, it is, in my opinion, a foregone conclusion that we will enter a recession at some point. So yes, if rates remain elevated and continue higher, let's say they go to 9%, say they go to 10%, that is definitely going to dampen demand. And that could be one of the things to bring down prices. But if we have a recession because of these indicators, that interest rate that is currently rising would more than likely, in fact, in all cases in history, revert lower. So just a couple things to think about. If you're in the recession camp, then you don't have to worry about this. If you're not in camp recession, then higher rates could definitely be a risk to the housing market. All right, number 2, these are 7 reasons to be bearish on the housing market. Unemployment will force homeowners to sell. Absolutely true that when we enter a recession, people will lose jobs, and that is incredibly unfortunate. And people, suffer through those periods of time. And perhaps some of them won't be able to make their mortgage payment. But think about this. Many of those people refinanced over the last 3 to 4 years. In fact, 90% of all mortgages in the entire country, first of all, 1/3 of all homes in the United States are paid off. The 2/3 that have mortgages, of those, 90% have a 5% interest rate or less. And greater than 90% of all mortgages in the country, I think the number is like 93 or 95%, are fixed rate mortgages. So even if these people lose their jobs, the chances are that they locked in a very low interest rate mortgage, and it may be cheaper for them to figure out how to make their mortgage payment than it is to go find someplace else to rent. The other thing to be aware about is equity. This chart here shows the amount of household equity, and we'll just pay attention to this gray bar, which is the total. If you look at the top of this curve here, this is the total amount of equity. The gray section they say is non-tappable, meaning you can't extract the equity without selling. The blue section is tappable equity, which you could get a loan for. Usually that's at 80%. Yeah, that's at 80%. But we'll just look at the full equity position. So in 2006, there was approximately $9 trillion in equity in the total US housing market. If you forward to 2023, this actually goes to June of 23. Right now, that number has eclipsed $17 trillion in equity. So you almost have a doubling in the amount of equity in these homes. And so when you think about, what would happen if a large number of people lost jobs because of a recession, there's two things to consider. Number one, they have to live somewhere. And would it be cheaper for them to stay in their homes at their 2, 3, and 4% mortgage rates or move out and rent? And two, will that forced selling of those properties, is that going to result in any kind of a short sale or foreclosure or banks taking back large numbers of properties? And the answer to that is clearly no, because of the $17 trillion worth of homeowner equity that we have now. So I think that as we go into a recession, some people will likely be forced to sell. Others will just rent out their homes and take the positive cash flow. Because if you bought a home in 2017, 18, 19, 20, you locked yourself in a 3 or a 4% rate, there's about 100% probability that you could rent that house out for a positive cash flow, unless you bought in the very highest cost of living areas, like maybe a San Francisco or maybe, Malibu or something like that, where you're not able to get enough cash flow. But these folks have options. They have low rate fixed debt on the homes, and they have massive amounts of equity. Risk number 3, Airbnb bust. I don't know if you guys follow Twitter or Reddit or any of those kind of those chat and communities, but there's a lot out there going on about fear around the Airbnb bust. And yeah, I think that revenue model, that nightly rental model, or even short-term rental model, is likely in for some trouble, especially if we go into a recession, because people will spend less. So that means they're going to rent less expensive homes to go on vacations. But again, if we think about the fact that 80% of all mortgages in the United States have a 4% interest rate or less. So again, of the homes that have mortgages, 80% have a 4% or less coupon, meaning interest rate mortgage, and 90% have a 5% or less. So let's say that somebody bought a home in 2020 or 2021 when Airbnb was going bonkers and they were having great nightly rental rates. And now, fast forward 3 years later, the nightly rentals disappear. Well, if they locked in one of those low interest rate mortgages and they're one of those owners that are sitting on some of that 17 trillion in equity, they're likely just going to convert their Airbnb rental, their vacation rental, into a long-term rental. We're already seeing people do that. So I think this is something that could add a little bit of inventory to the housing market, but I don't think it'll be substantial. And then the last thing is we just put in this rental vacancy rate in the US. The current rental vacancy rate in the United States is the lowest it's been in 30 years. In 2022, it was slightly lower, but it's right around this 6% mark. And historically, that has been closer to 7 or 8% vacancy rate. So these folks that have Airbnbs, they don't have to sell. They can take advantage of this low vacancy rate and just turn them into long-term rentals. Hey, I see we had a few more people join us. Welcome to the webinar. Feel free to use the chat if you have any questions. We're more than happy to answer any questions, or if any of this doesn't make sense, we're happy to go deeper on any of these points. We're going through the 7 reasons to be bearish on housing, and number 4 is foreign buyers leaving the market. This is true. Housing's not as affordable as it was, especially prior to 2017. You can kind of see that 2017 was the banner year here. The blue bar is non-residential. These are apartment buildings and offices and whatnot. The light blue is residential purchases from foreign investors. And you can see, in the years leading up to 2017 and even 2018, there was a lot. These are billions, right? $78 billion of residential purchases by foreign buyers. Housing was a lot cheaper at that point, and it made a lot of sense. And the dollar was weaker. So the exchange rate, the dollar has really strengthened against pretty much every other foreign currency. And so for both of those reasons, there's been less activity from foreign buyers, less purchases from foreign buyers. But if you look at this trend, it topped out in 2017. It's been going down ever since then. So 2018, 2019, 2020, 2021, each year we're seeing less and less foreign buyers. And yet, in spite of this reduction in demand from foreign buyers, home prices were incredibly appreciated incredibly fast. In fact, over the last 5 years, if you look at 22, 21, 20, 19, and 18, over those 5 years, the average house in America appreciated by 50%, 50% appreciation. So again, I don't necessarily think that this is going to be something that the trend has already been lower in terms of foreign investors, and home appreciation has still been on a rocket ride. All right, reason number 5, Wall Street will start selling if rents fall or rates rise. This is an interesting one because this is also a slide that we have in the bullish section, because the number of single family homes being acquired and owned and rented out by Wall Street is absolutely shocking. And I have to believe that Wall Street is smart enough to negotiate longer term fixed rate debt on these properties that they've acquired. And again, over the last 5 years, we've seen a massive amount of increase in rents. So is this a risk? Yes, it's possible. But Don Mullen, who runs Pretium Partners, he's one of the largest private owners of single-family homes and rentals. I believe Pretium Partners owns $63 billion of residential real estate, single-family homes, housing. He said in January of this year on a Bloomberg interview that residential real estate is a much more attractive investment opportunity than it was in 2008. So Don's not going anywhere. And I'll show you a slide a little later in the presentation showing that Wall Street is still buying at a very, very fast pace. All right, number 6, stock market crash. This one is interesting because we all have a little bit of recency bias towards the Great Recession. And we associate the Great Recession with a housing crash. And therefore, we associate recessions with a housing crash. But historically, if you look back over how housing has performed throughout the last 6 recessions, in 5 of the last 6 recessions, housing prices have gone up or flat. It's only in the Great Recession that housing prices went down dramatically. And again, the reason for that is this. When the stock market crashes, it's usually because something really scary is happening in the economy. Think about that Lehman Brothers moment where we were worried about our entire international banking system, and money was flooding out of the stock market. It was going into the bond market, which is considered a safe haven investment asset, and that drives mortgage rates down. So the reason why housing usually does well in recessions, contrary to our recency bias because of the Great Recession, is because housing becomes more affordable because of lower mortgage rates during the recession. And this is just kind of a map of the S&P 500 going back to 1975, or a graph of the S&P 500 going back to 1975, as compared to the Case-Shiller National Home Price Index. And you can see, in 2000, we had a pretty wicked, and I've got a graph that'll go back 50 years here in a minute we'll get to. We had a pretty wicked pullback in the stock market, and yet housing did quite well and continued to accelerate. All right, reason number 7 that I'm hearing people are worried that we may have a housing crash is that the 1% down payment loans are back. There's a few of those being done, not a lot, but there's a few of those being done out there. and then what's called non-QM loans. Non-QM loans are called non-qualified mortgages. Those are loans that the documentation of income may not be from tax returns. It might be from bank statements, or it might be from some other means of verification of income. These loans also oftentimes will have more lax parameters for if somebody's newly self-employed, if they're buying maybe a non-warrantable condo, like a condo-tel or something like that. So these loans, they have a little bit of hair on them, a little bit more risk associated with the non-QM loans. And so there's a fear that the return of some of these types of loans could crash the housing market. But here's a couple of points that I think we should compare or we should consider. This orange or gold line here, these are non-QM loans. And you can see that at the year end 2022, the average FICO score of the borrower who took out a non-QM loan was 771. That's an impeccable payment history. So the person has definitely demonstrated the ability and the willingness to repay their indebtedness over a long period of time. And then factor number two we should analyze is the loan to value. Now, this is the loan to value when the person took out the mortgage. It doesn't count for the fact that we've seen 50% appreciation over the last 5 years that is above and beyond this. But when the person took out the non-QM loan in 2022, the average loan to value was 76%, meaning that they put a 24% down payment. So yes, there are a few loans being issued that have a little bit lower underwriting standards in terms of down payment or non-QM qualifications, but credit scores are very high. And when it comes to non-QM loans, there's significant equity, lots of skin in the game. So this is something to keep an eye on. But as we look overall across the entire landscape of all mortgage properties in the country, we right now have the lowest foreclosure or 90-day delinquency. We have the lowest 90-day delinquency rate of all time, except in the middle of COVID, because there was a foreclosure forbearance. So except for that period of time, right now, we have the lowest foreclosure rate of all time. So we would have to see that delinquency rate really tick up before this really became a reason that the housing market could crash. All right, well, we're going to move on to the 7 reasons to be bullish on the housing market. Again, I welcome you, if you're watching us on Facebook, we're streaming live, any of those platforms, or if you are on the webinar, go ahead and enter your questions in the chat, any feedback that you have for me. We'd love to hear the feedback or questions. All right, reasons to be bullish on the housing market. Number 1, resiliently strong appreciation. I would add incredibly resiliently strong appreciation. I mean, if you told me that mortgage rates were going to go from 2.5 or 2.75 to almost 8%, and some loans are north of 8% right now, I would have said the housing market's probably going to be down 5%. That would have been my guess. But that is absolutely not what's happening. So let's look at this. There's really 5 companies that are the major data aggregators as it relates to home values in the United States. Case-Shiller is considered the gold standard, FHFA, CoreLogic, Black Knight, and Zillow. And I like to follow all 5 because then we can really see what's going on because they all have a little bit different mechanisms by which they manage which they measure housing values. But we can see in January of 2023, we had 3 out of 5 of these home valuation data aggregators report negative home values. That means, depreciation. And we had only FHA and Black Knight up 0.1%. So home values were kind of correcting here in the first quarter. And the same thing in the fourth quarter of 2023. There was a little bit of correction, about 5% trail off in the fourth quarter of 2022. And then in 2023, in January, a little bit of a downward trend. But then in February, we only had one down. Zillow said that real estate values were down based on their metrics, but 4 of these data aggregators reported positive appreciation. And then any of these slides or squares that are highlighted in yellow, that means that that's a new all-time high reading in real estate values. Because if you remember what happened, June of 22 was like the peak of the previous peak. And then rates went up towards 7%. We saw about a 5% correction in the fourth quarter of 2022. The year still ended up positive because the first half of 22 was very positive, but we started to kind of turn over in values. And then in the beginning of 2023, starting in February and March, we start to see values come back up. So FHA in February said, hey, this is a new all-time high in values. In March, 5 out of 5 show appreciation. April, 5 out of 5 show appreciation. May, 5 out of 5 show appreciation. June, 5 out of 5 show appreciation. July, 5 out of 5 show appreciation. And unfortunately, we only have Zillow for August, which shows 0.2%. So if we kind of average these and forecast out based on the data that we have for the first 6 or 7 months here, we can kind of come up with a 2023 pace of appreciation. Case-Shiller shows we're on pace for 5% appreciation, FHA for 7%, so on. And as an average, if we average all of those, we're on pace for about 7% appreciation for 2023. That blows my mind. To see mortgage rates go up, 300% in a period of a little over a year, and to see mortgage and to see appreciation still moving forward at 7.3%, that is 7.2%. That is really wild to me. And I think I can explain why. This next slide is the most important slide of the entire presentation. So if I've lost you because I'm boring, come back to me now and pay attention for just this slide at least. There is a massive housing shortage out there. When we were in the depths of the Great Recession, there were 4 million homes listed on the multiple listing services across the United States, 4 million homes for sale. As of last week, there was about 970,000 homes for sale across the entire United States, according to Redfin. Now, let's figure out why do we have this shortage. And to do that, we're going to look at household formations. That's the number of households that are being formed. So for example, I live at home with 2 kids. When those 2 kids move away, they will form their own households. So now you'll have, instead of 1 household, we'll form 3 households, right? That makes sense. And we're going to compare the number of household formations, essentially demographics, to home completions. These are the finished residential properties ready for people to move into. And if we compare those 2 things, what we'll find is that household formations, that's the number of new households coming into existence because of divorces or kids moving out and so on and so forth, was running along in 2004 at about 1.7 million household formations in 2004. Let's call it 1.75 in 2005. And then, whoom, we see this huge drop in household formations in 2006, and household formations drop to about 500,000 a year. Think of that. That's about a 66% reduction, maybe a 70% reduction in household formations that happened right during this period of time. But guess who didn't get the memo? Builders. Builders didn't get the memo because builders built about 1.75 million homes in 2004. This is actually homes and apartments, by the way. These are total residential units. So we're measuring total residential completions versus total household formations. And then in 2005, builders built about 1.8 million units. And then, oh my gosh, 2006, over 1.9 million. This is the most residential completions ever in the history of the country, right when household formations fell through the floor. So what's the net result? For 10 years, from 2004 to all the way to 2014, builders were completing more residential units than we had household formations. So here's another way to look at it. We all took Econ 101. This is the supply, the gold bars, and the demand is the household formations. So builders out-supplied the market for 10 years from 2004 to 2014. And then in 2015, something interesting happened. This reversed. The formations started to beat the completions. Now, before we go into that, does anybody know why there was this huge drop in formations in 2006 and why we went from 1.7 million household formations approximately in 2004 and 2005 down to 500,000 household formations? Well, we know that the average first-time home buyer is 33 years old. And if we minus 33 from the year 2006, when there was this huge drop in household formations, we come up with 1973. And if anybody knows what happened in 1973, there was this, this landslide change in legislation over abortion rights. We had Roe versus Wade. So Roe versus Wade happens in 1973. Birth control and contraceptives become mainstream, and we have this massive pullback in household formations because 33 years before that, we had this massive pullback in Generation X, which is my generation. Boomers, huge generation. X, small generation. Then we go on to the millennials. And this is the millennials coming out of this demographic trough, forming households and really gaining steam in 15, 16, 17. And again, if we go to 2023, check this out. Our household formations are estimated to be back where they were pre-Gen X period. So we're back to that 1.7, 1.8 formation. So here's what I want you to compare. From 2004 to 2014, way more supply completions than demand household formations. From 2015 to 2023, and going forward with the millennials, followed by Gen Z, which is almost as strong from a demographic standpoint, now we have more demand formations than we have supply completions. So if we want to solve this riddle, how do we see 7.2% appreciation in housing in the United States when mortgage rates tripled? Well, it's because demand has exceeded supply for a decade, and we have a huge shortage in housing. All right, reason number 3, to be bullish on housing, corporations are buying up supply. Look, I'm gonna move through 2 slides on this, but here's a bunch of quotes. If you haven't tuned in on this, feel free to Google it or check it out on Twitter. Here's why now formerly known as Twitter, now known as X. Here's why BlackRock or State Street or Vanguard will be your kid's landlord. So these entities are buying up hundreds of thousands of single-family homes, multi-units. They want to own everything. And I don't know if any of you saw this really cool Twitter take. This is actually a podcast, and then there was a little reel made out of it, and it made its way to Twitter. And in it, RFK, who is Robert F. Kennedy Jr., explains how corporations, BlackRock, State Street, Vanguard, they own, according to him, 89% of the S&P 500. That's an unbelievable number. And he says that now they've had enough of the S&P 500. Now they want to own homes. And they are ramping up their purchases of residential homes. In fact, RFK Jr. says that by 2030, if they stay on the same pace of acquisition that they've been on, that they could own 60% of the single family homes in America. Not 60% of the rental homes, 60% of all homes. That seems a little out there for me. This is definitely one of these things that gets 6.6 million views because it's extreme. But the point is, corporations are continuing to buy up residential housing. And if you think about it and you go, well, why would they do that? Well, it's because they understand this. They understand that demand for housing formations has exceeded household completions or home completions for 10 years straight. And if there's a shortage of housing, they want to own it, because once they can control it, they can control the rents. So that's another reason to be bullish on housing. It may just get harder and harder to own a home because we're competing with Wall Street and cash offers. All right, reason number 4 to be bullish on housing: rates will fall and unleash pent-up demand. Look, we talked about a lot of the millennials and now Gen Z being priced out of the mortgage market. They're renting in droves, and they want to get into the housing market, but they feel like it's a terrible time because mortgage rates are where they are. But here's the thing: when we go into a recession, which is shown here by every recession going back to 1981, we see mortgage rates drop. In 1981 recession, interest rates dropped from 16% to 11.75. In 1982, 83, no, that would have been 82, mortgage rates dropped from 18% to 13%. In 1991, and by the way, they dropped from 18% to 13%. They dropped 5% in the span of less than a year. So, I mean, mortgage rates moved down fast in that recession. In 1991, they dropped from 11% to 8.75%. In 2002 recession, interest rates, maybe that's 2001, 2002, right in that range. Interest rates dropped from 7.37 to 6.75. In 2009, the Great Recession, mortgage rates dropped from 6% to 4.875. And then in the COVID recession, from 3.75 to 2.75. So as mortgage rates drop, that will increase affordability, and that will bring buyers off the sideline. And again, we saw those demographic trends: 10 years of more household formations than home completions. There's a lot of pent-up demand out there. Mortgage rates just have to get accommodating enough to bring those people off the sideline. And I think that will be very bullish for housing. Number 5, mortgage rate lockdown. The number of homes changing hands has greatly diminished because of the mortgage lockdown. This is the chart that shows the distribution of mortgage rates of all current outstanding loans. And you can see that the vast majority of these loans are in the 4.5%, 4%, 3.5%, 3%, and 2.5%. And hey, homeowners know that not only is their home an asset because they have a lot of equity, but their mortgage is now an asset. That their debt instrument is an asset because it's locked at 3% and the going rate is 8% or 7% or 6%. So a lot of homeowners will turn these properties into rental properties. They'll never walk away from these mortgages. A lot of these folks will perhaps even agree to sell their home and do what's called an all-inclusive trust deed, or subject to the financing of the existing, where they essentially leave the existing financing on the home, sell the home to somebody new, and then the new person makes a payment to an escrow company that pays the underlying mortgage, and perhaps makes a payment to the seller of the home who's moved on. So a lot of this mortgage indebtedness won't be repaid. And it makes it so the debt service on those mortgages is so low that people are going to be very unlikely to sell in an unorderly fashion. Number 6, lending standards are much stricter and stronger than they were leading up to the Great Recession. This is the Mortgage Credit Availability Index. This is something put together by the Mortgage Bankers Association. And basically the index, once you get over about 400 to 500, the higher the number, the easier it is to get credit. Once you get over 400 or 500, you either have to spell your name or fog a mirror to get a mortgage. That's it. You don't have to do both. Either one of those things will get you a mortgage when you're in this kind of a mortgage credit availability range. And you can see things just got way out of hand. No income, no assets, no job, one day out of bankruptcy, no down payment, no problem. You could get a mortgage back here. But below 100 is considered restrictive credit standards. And you can see that Mortgage Credit Availability Index was getting a little better through 19. Then, of course, we had COVID, and mortgage credit availability contracted. And right now in 2023, mortgage credit availability is amongst the lowest ever since this index has been tracked. What that means is all of those people with the 3, 4, and 5% mortgage debt, they all qualified with real FICO scores, real income, real down payments, and a real ability to repay the indebtedness. So it wasn't a debt bubble that was taken out like happened before the Great Recession. And then number 7, this is interesting and it's a little esoteric, but people who are really into studying inflation will get this. And if you don't get it, it's okay. But I think it's important because I think it really does have bearing on the housing market. And so that is, if you count for inflation, housing has already corrected. So let me explain what that means. When we think about dollars, we call a dollar in 2023. And in 100 years ago, in 1923, we called that same dollar a dollar. But are they the same thing? No, not even close. In 1923, I could buy a whole bunch of stuff for $1. In 2023, I can buy no stuff for $1. I don't know if you've been in the dollar store lately, but even the dollar store, it costs more than $1 now. They got to get a new name. So the difference between those two things, it's called real or nominal. Nominal is name alone. So in nominal terms, $1 is the same in 1923 as it is in 2023. But in real terms, adjusted for inflation, the dollar in 2023 is worth a lot less. So if we adjust home values for inflation in that same way, you can see that in real terms, housing is way higher than it was in 2006, 2008, significantly higher based on the Case-Shiller Housing Index. But if you adjust for inflation, which has essentially distorted the value of money, you see that housing values in real terms are really only slightly higher than they were in the Great Recession. Now, if you're not a nerd like me, that probably made 0 sense, and I'm sorry. But I thought it was important to point out, and hopefully there's at least one more nerd in the audience that thinks that's good information. All right, so what's our predictions for 2024? We believe that home affordability will improve for the 3 reasons we covered. Inflation is trending down, and historically, mortgage rates always follow inflation. And as we go into the next recession, we will see inflation continue to trend down, and we'll see mortgage rates follow. And hopefully the government doesn't need to borrow $2 trillion every 4 months. Hopefully we can slow down the pace at which the Treasury is selling bonds and competing with mortgage rates. And incomes are increasing. Remember, we think what will bring back affordability is not a crash in housing because of the demographic information we went over. We think what will bring back affordability is the rise in people's incomes and the fact that mortgage rates will go down. And then we believe that housing supply will remain low because of the subdued new construction and higher household growth rates. Look, there's about 1.7 million household formations going on right now. There's only about 1.3 million new homes being built, residential apartments and single family homes being brought to market. So this year in 2023, we're going further into the shortage in housing by another 400,000 units because there's 1.7 million new households and only 1.3 million new units being brought to market. So we believe that'll stay consistent, low inventory. And all of these builders that are building residential homes and apartment buildings and all those things, those are all slowing down, grinding to a halt, because it doesn't make sense for those builders to build at 8% interest rates. So they're slowing down the number of construction. But higher interest rates don't slow down household formations. That's a freight train that is moving forward and nobody can stop. All right. And we believe that rents will remain elevated because of historically low vacancy rates for all the reasons we just talked about, the demographic reasons. So at the end of the day, we believe 2024 will be low single-digit appreciation, meaning, 5-6% ish for most of the US, with a pickup of activity and mortgage rates falling before the summer. Now, this low single-digit appreciation forecast, if we get kind of a gnarly recession, if you're in camp gnarly recession and mortgage rates really drop huge like they have in some of the recessions in the past, we could see double-digit appreciation. But again, we're still fighting that affordability issue. So that's going to be a constraint on appreciation. But definitely, we're not seeing a major indicators for a housing crash. Now, there's one more thing I wanted to bring up to everybody's attention. This issue of higher mortgage rates, in my opinion, is not a 30-year problem. It's a year problem. Maybe it's a 2-year problem. However long you think it's going to take us to get into a recession. And then as those mortgage rates come down, it's going to be incredibly wise to restructure your indebtedness. One of the things that we do with every client that we serve, every family we serve, is that we track their interest rate relative to the market. And we employ a professional artificial intelligence program that monitors that database every day to let us know if it would make sense for somebody to restructure their indebtedness, and we proactively reach out to them. All we need to do is figure out, how do we make housing affordable between now and when we have the next recession and mortgage rates go down? And so there's a couple of ways to do that, which I'll just point out. I don't know if many of you know this, but it's possible to get the seller to subsidize your monthly payment. This is a case study we did for a client the other day. And they were buying a $600,000 house. They wanted to put $60,000 down, or 10%. Their payment with taxes and insurance was $45.91. And that was just a little bit more than they wanted to pay. They really wanted to be sub $4,000. So we said, okay, we've got two options. When you go in to make this offer on the home, instead of asking for a price concession, ask for the seller to kick back to you 3% of the value of the home, which can be used to subsidize your payments for the first 2 years. And that dropped their payment down for the first year to $3,870, which was below their goal of $4,000 a month. So that's option number one. Option number two, depending on how long the home's been sitting on the market, depending on how hot the zip code is that you're looking for a house, if you can get the seller to contribute 5%, we were able to get this client to subsidize the payment down to $35.34. So there are options out there. If you believe this data and this makes sense to you and you want to get into the housing market, but you don't like the payments, let's talk about what type of seller contribution to subsidize the payment. Happy to walk you through and show you those things. And then just two other tools that I was doing for a client today. If you own a home right now and you're a little, kind of wonky on what's going on with home values, we have this great market analysis tool that'll tell you with incredible accuracy what the likely value of your home is. It'll tell you the high and low. It'll tell you all the neighbors around you, what the values of their homes are. It'll give you information about your home, historic valuations. So if you want an updated valuation of your home, just shoot us an email, whoever invited you here today, or I'll give you my email, and we're happy to do this for you. We can also create this real estate report card. So for this client, they're kind of thinking, hey, should I stay in my home? Should I sell my home? Should I rent my home? So we gave them a market analysis to show them what the value of the property was. And then we charted for them based on their specific home value and their specific neighborhood. We showed them what is the anticipated appreciation in that area over the next 5 years. So what kind of equity could you possibly grow over that period of time? And then we showed them historical appreciation rates. We showed them that in their area, the average days on market is about 45 days, which makes sense for a $2 million home. They take a little longer to sell. It shows them how many listings hit the market. In his area, there were only 17 new listings in that zip code, and that's down 5%. So the amount of inventory is actually going down, and it shows a bunch of other great demographical information. So if you're interested in a market analysis or what we call the real estate report card, or you want us to go a little bit deeper in how you can get the seller to subsidize your payments until mortgage rates go down, happy to walk you through any of that stuff. Feel free to give me an email or reach out to the person who invited you to the webinar tonight. And with that, I don't see that we have any additional questions. So I'm happy to stick around if anybody has any questions. And if not, thank you so much for coming. I hope you found this valuable, and we look forward to serving you in the future. All right, going once, going twice. We're out of here. Everybody have a great night. We'll call that